Ben, can we just start with a very simple question? For the companies under your coverage right now, is this business lost or business just delayed?
It's business delayed for now. The shipping is going to be rerouted, at least in the short term. And as you mentioned, even if, as many of you mentioned before, even with a week or two delays, that can have effects on the shipping industry for 6 weeks is one estimate for Maersk, but other estimates are 3 or 4 months. So it's likely to be delayed in our opinion, but where business loss might come in the future is if the strike continues for 2 to 3 weeks and continues on in perpetuity there. That's when the risk really begins to increase for business loss, shipments maybe not making it for Christmas, those sort of second, third order effects.
Ben, we've talked a number of times on this programme about the sheer volume, the high volumes going through ports through the summer, largely in anticipation of this and for other reasons as well. Ben, how much of a bump did they get ahead of this, the companies that you cover?
Yeah, it's hard to say how much of the bump early in the summer was in anticipation of this. A lot of it had to do with the disruptions in the Red Sea and delays associated with having to reroute around the Cape of Good Hope, and some of the bigger companies that had means to get ahead of this got ahead for that reason, also in anticipation of this. So I think that much of this has been avoided. Even in standard years, the heaviest shipping for the Christmas, for the December boom, it would be finished by now. So I would expect that many of the larger firms, the majority of the economy, has prepared for this disruption. And again, as I mentioned, even a prior year, a lot of the Christmas inventory would already be there and already be accounted for.
But I'm curious, longer term, whether this allows shippers to increase their costs on a structural basis, just to ensure against some of the disruptions that we've seen, not just the strikes, also the attacks in the Red Sea. Just a real question here about how to bake in a higher profit margin to gird against such events.
Yeah, short term, they're trying to mitigate some of those costs with surcharges, but long term, I don't really see them being able to bake that in. The industry already does as much as they can to try and scrounge out whatever margins they can, whether that be joining alliances to kind of come together to share their resources, or whether that be through new models. And Maersk and Hapag-Lloyd in their recent alliance are trying to hub and spoke model, trying to more efficiently manage their ports. But that being said, this is the freight container prices are commoditized, and it would be difficult even in the long run to, I think, really change the structure of that industry and to really bolster margins further.
Which shipping company right now, Ben, do you think has the biggest advantage, either coming into or coming out of any potential disruption?
I wouldn't say any. They're all kind of impacted in similar ways. Hapag-Lloyd has an opportunity to benefit the most, given that they are, or benefit a good deal, given that they're more of a pure play ocean shipper. If rates are to increase, which I would anticipate that they would, that would be a big tailwind for them. The reason for our sell rating is based on just Morningstar's methodology, that we are very long-term in focus, and Hapag-Lloyd's shares often do trade with the trends of the container index. So if you're looking for something short-term, there is potential that they could rise with some of the more temporary increases in rates that would be seen if there is a supply disruption as a result of these delays or as a result of the strike. But other than that, it's kind of an equal opportunity industry.